Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. So today we're going to look at our first Form 1040, and 1040 is essentially the form that individuals use to file their federal individual income tax return. So as we jump into this question review, or this comprehensive problem review rather, this isn't just going to be a boring, number crunching session. Instead, we're going to be looking at the story of Amunette Tallbear. So here we have the instructions. It says Amunette Tallbear is a single taxpayer. Her birthday is May 18th, 1997. She lives at 1919 Barker, Cypress Road, Cypress, Texas, 77433. Her social security number is 466331234. And for 2024, Amunette has no dependents and received a W-2 from her job at a local restaurant where she is the cashier. These wages are Amunette's only income for 2024. Lastly, Amunette does not own any digital assets. Required. Complete Form 1040 for Amunette Tallbear for the 2024 tax year. If there's an overpayment, she would like a refund. She wants to donate $3 to the Presidential Election Campaign Fund. The election to donate does not affect tax liability in any way. So when we look at the Form 1040, I'm actually going to show you guys what it looks like. So there's a section on Form 1040 that asks if you want to donate to the presidential election campaign. I've been doing taxes for almost over 15 years and I can count on my hands the number of people that I've elected. Almost everyone says no, but there are some people that, they want to, but for the most part, you still want to ask clients because there are some that would like to donate. But for the most part, as mentioned, I almost never see anyone say yes, but it is a question. It says that Amunette has health care coverage for the full year. There used to be tax years where individuals were penalized if they did not have health care, but here it's letting us know that she has health coverage. It asks for us to enter all amounts as positive numbers. If an amount box requires no entry or the amount is zero, then we will enter zero. And if required, we are going to round amounts to the nearest dollars. So here's one thing to keep in mind. As we're working on this tax return, it's pretty straightforward. She's a 27-year-old cashier from Texas. She received her W-2 in the mail. She's single. She has no dependents. And she has no digital assets. So for the most part, her tax return is going to be pretty straightforward. So even simple tax returns, they have a story. So ultimately, we are telling Amunette's story as we prepare this tax return. So here we see her W-2. As we know, she's a she works at a local restaurant and she's a cashier. So here we see her W-2. This is what, most W-2s look like. Even if they use different payroll providers, they might use ADP or they might use Paychecks. Doesn't matter. It's going to look the same ultimately. So we have the employee's information, their social. We have the employer's identification number, which is basically like a social security number for the organization. We have the name of the employer that she works for in box C. We have the employee's first name, initial, their address, and things of that nature. And then all of the important information can be found in boxes 1 through 20. So box 1 shows us the taxable wages for the period. As we move on throughout the semester, we're going to see that sometimes boxes 1, 3, and 5, they don't always match. And there's reasons for that. Maybe the individual works for a company where they have deferred compensation. So for an employee, instead of receiving the income, they put it away in a retirement plan and it's deferred. Defer basically means to postpone. It means to delay. So it doesn't mean that the money is never going to be taxed. It just means that it's not taxed right now. So those would be some of the reasons, just giving you guys some insight. In the future, when we work on other tax returns, you're going to see that boxes 1, 3, and 5 do not always match. They're not always the same. So in box 2, this lets us know the federal income tax withheld. Box 4 shows us social security taxes withheld, which we're going to learn throughout the rest of the semester that social security tax is 6.2%, but there is a cap, and with each new year there's an increase to the cap. But let's say it's 165,000. Once Amunette earns more than 165,000, she's no longer subjected to Social Security taxes, that's 6.2%. Medicare taxes, however, there's no cap. It doesn't matter if you make $1 million, you're still paying 1.45% on all income. So a lot of times taxpayers, they get confused, they get frustrated at year end when their refund isn't as big as they want it to be, or they have a balance due. The first thing they'll say is they take out all these taxes. True, but not all taxes are the same. So as we see, about $2,000 of taxes went to Social Security and Medicare taxes, and only close to 1,300 went to federal income taxes. And this amount in box 2 ultimately has a direct impact on what your tax refund or tax liability is going to be. And then there's some other columns here. So 7 is for Social Security tips, 8 allocated tips, 10 dependent care benefits. So you'll see she has a very simple tax return for the most part, but depending on the client, the W-2 can become a bit more complex. There might be information in box 14 that you need, box 12A, and then because she lives in Texas, she's in a state where there are no taxes. So there's 9 states where there are no income taxes. So that is something to keep in mind. Depending on the state that the individual lives in, then they ultimately will not be subjected to taxes. All right. So definitely want to keep that in mind. Again, Texas is definitely one of them. All right. So we have all this information here. Now we look at Form 1040. So Form 1040, again, this is the main form that we essentially use all individuals. So your state might be a little different. Again, in Amunette's case, she doesn't need to file a tax return for Texas. However, if an individual meets certain situations, certain scenarios, then they have to file a federal tax return. So this is what the 1040 looks like. It says U.S. individual income tax return. Businesses, different entities, they have different tax returns that they use. Is for the year 2024. It has her name. She has no middle initial, but if a person lists their middle initial, it'll be reported on that line. Their last name, if she were married and it were a joint return, their information would be here. Also, if she was married but filing separate, the spouse's information would also be there, as well as their social, has the address. Here you see foreign country and name, and you might say, wait, what? If we're filing a U.S. tax return, why is there foreign information? There are some individuals that are U.S. residents, but they live overseas. They are called expatriates or expats. They also need to file a tax return, because what we're going to come to learn is that gross income isn't technically defined in the Internal Revenue Code. However, as long as you are a U.S. resident, you are taxed on income from whatever source derived. So I am a U.S. citizen. I have family all over the place. My family, my mom and dad, they're from Guyana. Let's say I go to Guyana and I start a business, even though I'm a U.S. resident and the business is in South America, doesn't matter. I will still need to report that income on my U.S. tax return. Let's say the business is doing really well and I decide that I'm going to move there. I'm still a U.S. citizen, so I would list my Guyana address essentially. So that's why you see foreign country name, etc., just in case your home address is not in the States. Next, we have filing status. So we have single, we have married filing jointly. That's where, again, you're married, you decide to file together with your spouse. Married filing separate, you guys are married, and in certain situations, they decide to file separate. Head of household, that is ultimately you are not married and you have a dependent child that you care for, and there are some scenarios where you are considered head of household even though you are married, and that's the abandoned spouse rule, which we'll get into a little later in the semester. And then qualifying surviving spouse, you were married but unfortunately your spouse passed away and you still have a dependent child. So the goal of the qualifying surviving spouse or the qualifying widower filing status is that there's a loss of income. So in such case, to kind of help to compensate for the loss of income, as a qualifying surviving spouse for 2 years after your spouse passes away, you still get the same standard deduction and your tax rates are the same as though you were still married, so long as you have a dependent child. And then lastly, if you're a non-resident alien or a dual status alien spouse, in such case, you still have to file a tax return, because even though you're not a citizen, you earned U.S. sourced income. Uncle Sam says you need to file a tax return. All right. So in such case, Aminute's simple. She's single. Then now, with the rise of cryptocurrency and digital assets, this is one of the ways in which an individual and their tax preparer can attest to the fact that, hey, yes, I did, receive cryptocurrency. Yes, I did sell cryptocurrency, or no, I did not. So in such case, she did not. So it's fairly straightforward. Standard deduction. It's asking, can someone claim her as a dependent? Can someone claim her spouse as a dependent? Does the spouse itemize on a separate return? So in such case, none of these apply. So therefore, none. She has no dependents, so it's pretty straightforward. So the first thing we need to focus on is income. So we see here income, there's different types of income. It asks us to input W-2 box 1, but as you can see here, all different kinds of incomes are listed. Here we see from W-2 if they were a household employee, and then we also see that there's tax exempt interest, qualified dividends, IRA distributions, pensions, annuities, social security benefits, if there's capital gain or loss, if they sold stock. And then we also have a different schedule, Schedule 1, for individuals that have other types of income. Maybe they have a business, maybe they have rental property and things of that nature. So income is the first section. Again, Amunette is pretty straightforward. So therefore, the amount from box 1 is $24,478.44. And again, as we're looking through this problem, keep in mind the problem wants us, sorry, let's go back. All right. So the problem wants us to essentially round up or round down depending on the situation. So as we know, 5 or higher, we round up, 5 or less, we keep it the same. So because it's 44 cents, as we've rounded, it's going to be $24,478 even. All right. Luckily, again, her situation is simple. So it asks us to add lines 1A through H. Nothing from 1B through 1I are eligible in her situation. So therefore, 24,478 plus 0 is 24,478. In this case, she doesn't have any of the other income like distributions and things of that nature. So next it asks us to add lines 1Z, 2B, all the way through 8 to get our total income. So therefore, 24,000 $478. So as you can see, when you're working with a simple tax return, it's easy. It's straightforward for the most part. So now it's asking us to get what's called our adjusted gross income. So our adjusted gross income is our total income minus adjustments to income, if any, but she has none. So therefore, it's 24,478 is her adjusted gross income. So now we move on to standard deduction. So this is essentially where things get a little bit, more fun. So the standard deduction, how I explain it to clients to make it extremely straightforward, think of it as an amount of money that Uncle Sam allows you to keep tax free. Right? So ultimately, depending on your filing status and your age, Uncle Sam, they preset an amount each year based on your filing status and your age. So here we see to the left, it shows us standard deduction for if you are single, married, filing separate. The amount that they allow you to keep tax-free is 14,600. If you are married, filing joint, or a qualifying surviving spouse, 29,200 is kept tax-free. And if you're a head of household, 21,900 is kept tax-free. So it says standard deduction or itemized deduction. So itemized deduction, these are essentially a list of personal expenditures that the IRS allows you to deduct, and some of them within certain limits. So it includes medical expenses, it includes state and local taxes, mortgage interest if you own a home, charitable contributions. So if your total itemized deductions exceed the standard deduction, then you claim standard deduction, vice versa. All right. So you basically take whichever deduction results in the lowest taxable income. So in such case, it doesn't tell us anything about Amunette owning a home, having medical expenses, nothing of that nature. So we can assume that she's going to take the standard deduction. And again, because she's single, that amount is going to be 14,600. So with that being said, of the $24,478 that she earned, Uncle Sam is going to allow her to keep 14,600 tax free. So with that being said, now we need to determine Well, what is her taxable income? All right. So before we get there, we see that there's qualified business income deduction. This we'll learn a bit more about, sorry, when we start to work with Schedule C. And in this case, she's not self-employed, so it doesn't apply. So for line 14, it asks us to add line 12 with line 13. So the total is going to be 14,600. And then now we can figure out what her taxable income is. So her total income is 24,478. And from that, we subtract the standard deduction plus the qualified business income, right, which was zero. So we subtract 14,600. So therefore, of her $24,478 in income, only $9,878 is considered taxable. All right. So now we're moving on to the part where a lot of people dread, right? Figuring out what the actual taxes. So based on her tax bracket, this is ultimately how we are going to figure out what her tax liability is. We'll compare it to the payments that she has already made through withholdings from her job, and that ultimately determines whether or not she is going to receive a refund or if she has a balance due. So now we get to the tax table. And it states, click here to access the tax table for this problem. The tax table, this is just some insight for you guys to be aware of. So the tax table is published by the Internal Revenue Service, often referred to as the IRS. And this is used to calculate the tax owed based on a number of variables. So one thing that I love about tax is that ultimately everyone's situation is a little different, right? So in the event that, let's say, Amunette had a child, things would look a little different for her. Or let's say that she sold stock at a loss. So there's a lot of nuance when it comes to tax. But in order to use the tax table, we need to know the taxpayer's taxable income, which we just calculated previously, as well as the filing status. So it's basically like connect the dots. I'm going to open it in a few and we'll see. So it states for us to scroll down through the columns for the taxpayer's taxable income. The ranges listed are in increments of 50. We'll locate the range that includes the taxpayer's taxable income, and then we'll locate the tax figure that corresponds, right? So you might be like, what? That doesn't make sense. So here we are. So we'll click on the tax table. And here we see, so we have this example. There's a married couple. They're filing a joint return. Their taxable income on Form 1040 is 25,300, right? So the first thing that we're going to do, we're trying to figure out, all right, their income is at least, but less than. So their income is at least 25,300, but less than 25,350. So this is our row. Now we need to figure out the column. We have a single column, married filing joint column, married filing separate column, and a head of household column. So we see we're basically connecting the dots. This is our row, this is our column. So therefore, based on their situation, their tax liability is $25,575. So we are going to do the same thing for Amunette. So we go back to our Form 1040 and we see, okay, taxable income is $9,878. So using the table, we know that we need to go to the 9,000s. So we scroll down, get there, perfect, here we are. So we know that her income again was $9,878. So her income was at least $9,850, but it is less than 9,900. So this is our row, and because she is single, this is our column. So we essentially connect the dots, and Amunette's tax liability based on her income and filing status is going to be $988. So the tax is going to be $988. And then if there were any additional taxes, that would be reported on Schedule 2 on line 18, and asks us to add lines 16 and 17. She's not subjected to any additional tax. So therefore, line 18 is going to be $988. And then there's, again, if she had a dependent, and she would get the child tax credit or credit for other dependents if there was someone other than a qualifying child. And then if there were any other taxes from Schedule 3. So none of these things apply in this situation. But again, every tax situation is a bit unique. So here we see we subtract line 21 from 18. There's zero, so the number remains the same. So again, because her situation is simple, it's pretty straightforward. Her tax liability is going to be $988. So this is how much she owes Uncle Sam. So keep in mind, Amunette, she's been paying taxes every paycheck. As an employee, that is one of the things that are required. The employer is required to withhold taxes on your behalf and remit them, give them to the proper taxing agencies. In this case, the federal government, the state, if she was in a state like New York, right? So in such case, now we need to look back to her W-2. Well, how much did she already pay in taxes? So box 2 lets us know that $1,251. Remember, we're rounding it. So because the cents are more than 50, we're rounding it up to 1,251. So based on that, thus far, she paid 1,251. So she owes 988. Her liability is 988. She's paid 1,251 thus far. So sometimes taxes not only come out from a W-2, it could come out from a 1099. Let's say you receive a 1099-R for retirement. In such case, taxes can also be withheld through that. But in such case, she doesn't have any other withholdings. So total amount withheld is 1,251. Then we scroll down again, the total amount, the total payments is 1,251. She doesn't have any credits and things of that nature. That ultimately, what we're going to learn as we go on through the semester is that credits, they are essentially a reduction of your tax liability on a dollar for dollar basis. So we're going to learn the difference between deductions, and then we're going to learn the difference between credits. So in such case, now it says if line 33, which is 1,251, is more than line 24, which is 988, she is due a refund. So that is ultimately the case in this situation. So her balance due was 988, and she paid in 1,251, so therefore she is due a refund of $263. So you could do it both ways. You see that I ultimately did it the reverse, but you could do it both ways. The 1,251 minus 988, same thing. $263 is owed. So what some individuals can do, they can apply it to their next year tax. I've seen that often in the profession, especially for those that receive income that is not subjected to tax. But in such case, we see $263. It doesn't say anything about her, converting it to last year. So in such case, here we are, 263. That is how much is going to be refunded to her. And just a few other things that I just want to point out. In the event that, let's say, her tax liability was 1,251 and she only paid in 988, she would have a balance due. And depending on the situation, she might also have a penalty. Third party designee. This is essentially if the taxpayer wants to allow another person to discuss their return with the IRS, you select yes. So for those of you that like taxation and want to venture into this area of specialty, in most cases, it makes the most sense for you to complete this section of the tax return, because if there's a question or, something that needs to be, checked in with the IRS, by being a third party designee, you can call in to the tax practitioner hotline, assuming that you are a CPA or an enrolled agent. You can, or a tax attorney, you can call in on behalf of the client and get information without the client on the line. You can also file a power of attorney and things of that nature. And then lastly, this is where the client is going to sign. So this is basically the client saying, hey, I reviewed the return. I agree with everything that is on it. So they're signing on the dotted line, and then paid preparer's name. So you've officially just prepared your first tax return. All right. So as we see, Amunette, based on her situation, she's getting $263 back. So this again is like a very simple example of how taxes work. In this day and age, over 90% of tax returns that are completed, they use a professional tax software, electronically filed, not paper filed. There are some situations where returns are paper filed. As we go through the semester, you guys are going to have the opportunity to utilize a professional tax software called Pro Connect. So you're going to get intangible, invaluable experience utilizing a professional tax software. So that way, the different theories that we learn throughout the semester, you can practically apply it using the tax software. All right. So, with that being said, Amunette, she's officially done. She's squared away. All she needs to do now is file it. So, filing taxes, I mean, it may seem intimidating, but once you break it down step by step, it's really just a story with numbers. What did you earn? What do you keep? And what do you owe? So, again, congratulations. You guys filed your first tax return.